You walk into a bank with $100. You hand it to the teller, they smile, they say thank you, they put it in a vault somewhere, and then they lend your $100 to 9 other people. Wait, how does that work? You still have your $100. You can check your account right now. It's there. But 9 other people also have your $100. They're spending it, buying cars, starting businesses, paying off debts, all with money that technically still belongs to you. This isn't a trick. This isn't fraud. This is how banks make billions of dollars every single year without selling a single product. And most people have no idea it's happening. Here's what makes this story strange. Banks don't make money the way normal businesses do. Apple sells iPhones. Netflix sells subscriptions. Your local coffee shop sells overpriced lattes. They create something, you buy it. Transaction complete. Banks don't work that way. They don't manufacture anything. They don't provide a tangible service you can hold in your hand. And yet, in 2023, JP Morgan Chase made $49 billion in profit. Bank of America made $27 billion. Wells Fargo made $20 billion. How? The answer is hidden in plain sight. It's printed on the back of your debit card. It's buried in the fine print of your savings account. It's woven into the architecture of the entire financial system. And once you see it, you can't unsee it. So let's start at the beginning. Let's start with what a bank actually is. A bank is not a vault. That's the first thing you need to understand. When you deposit money into a checking account, you imagine it sitting there, stacked neatly in a safe, waiting for you to withdraw it. That's not what happens. Your money doesn't sit, it moves. The moment you deposit cash, the bank takes it and does something with it, something you agreed to without reading the terms and conditions. They lend it out. This is called fractional reserve banking, and it's the reason banks exist. Here's how it works. Let's say you deposit $1,000. By law, the bank is required to keep a fraction of that in reserve. For decades, that fraction was 10%, so they'd keep $100. And the other 900, they'd lend it to someone else. But here's where it gets weird. That someone else takes the $900 and deposits it in their account, maybe at the same bank, maybe at a different one. Either way, the bank now has $900 new dollars, and they're required to keep 10% of that, so they keep $90 and lend out $810. Then someone deposits that $810, the bank keeps $81, lends out $729, and the cycle continues. Your original $1,000 has now become nearly $10,000 in the economy, all from one deposit, all technically backed by money that exists on a spreadsheet, but not in a vault. This is how money multiplies. This is how the financial system expands. And this is how banks make their first profit, because every time they lend your money, they charge interest. Let's follow the math. You deposit $10,000 into a savings account. The bank pays you 0.5% interest per year. That's $50. You're happy. It's free money for doing nothing. Meanwhile, the bank takes 90% of your deposit and lends it out as a mortgage at 4% interest. That's $9,000 at 4%, which means the bank earns $360 per year on your money. You get $50. They get $360. You did all the work. You saved the money. You took the risk of trusting the bank, and they make 7 times more profit than you do, just by moving your money from one column to another. But wait, it gets better. That $9,000 mortgage, the person who took it out is paying it back over 30 years. With interest, they'll pay nearly $16,000 total. The bank will collect $7,000 in pure profit on a loan they made with your money, money you can still access, money that still shows up in your account. The bank has created profit out of thin air. Not literally, but close enough. And this is just one deposit, one customer, one loan. Now multiply that by millions of customers, billions of dollars, trillions in circulation. The scale is almost incomprehensible. In 2023, American banks held roughly $18 trillion in total assets, But they didn't own $18 trillion. They owed most of it to depositors, people like you. And yet, they made over $300 billion in profit that year by lending money that wasn't really theirs to begin with. It's the most elegant arbitrage in history. Borrow low, lend high, repeat, forever.
Now here's the part they don't advertise. This entire system only works if you don't ask for your money back. Think about it. If you deposit $1,000 and the bank lends out $900, they only have $100 left. If you show up tomorrow and ask for your full $1,000, they don't have it. They'd need to call in loans, sell assets, scramble to find liquidity. And if everyone shows up at once, the system collapses. This is called a bank run, and it's happened before. In 1929, panic swept through America. People rushed to withdraw their savings. Banks didn't have the cash. They failed. Thousands of them. Life savings evaporated overnight. The Great Depression followed. In 2008, it almost happened again. Lehman Brothers collapsed. Bear Stearns collapsed. People started pulling money out of banks. The entire financial system teetered on the edge of total failure. The government had to step in with $700 billion in bailouts just to keep the lights on. And in March of 2023, Silicon Valley Bank failed in under 48 hours. Customers withdrew $42 billion in a single day. The bank couldn't cover it. It was the second largest bank failure in American history. Your money is safe until it's not. The system works until it doesn't. And the crazy part, the thing that makes this whole story even stranger, in 2020, the Federal Reserve dropped the reserve requirement to 0%. That's right, 0. Banks are no longer required to keep any of your deposit in reserve. They can lend out 100% of it if they want. Your entire deposit can be somewhere else, and the system says that's fine. So let's zoom out. Let's ask the bigger question. What exactly are you buying when you open a bank account? You're not buying security. Your money isn't sitting in a vault. You're buying a promise that when you ask for your money back, the bank will have it, or the government will cover it, or the financial system will hold together long enough for you to get out. You're buying trust. And trust is the most profitable product ever invented. Because here's the secret. Banks don't make money from lending your deposits. That's just the appetizer. The real profit comes from everything else. Credit cards. Banks issue cards with interest rates between 15 and 25%. You carry a balance of $5,000. They make over $1,000 a year. You pay the minimum. They make even more forever. Overdraft fees. You spend $3 more than you have. The bank charges you $35. In 2019, banks made $11 billion just from overdraft fees. $11 billion for covering transactions that cost them almost nothing to process. Investment services. The bank takes your money and invests it in the stock market, in bonds, in real estate. They earn returns, they pay you a fraction, they keep the rest. Currency exchange. You travel overseas. The bank converts your dollars to euros at a terrible rate. They pocket the difference. Account fees, monthly maintenance fees, ATM fees, wire transfer fees, fees for paper statements, fees for talking to a human, fees for existing. Every interaction is monetized. Every service has a price, and the price is always higher than the cost. In 2022, Bank of America made over $90 billion in revenue. Less than half of that came from lending. The rest came from fees, services, wealth management, trading, all the invisible ways they extract value from money that flows through their system. They're not a bank, they're a toll booth, and every dollar you touch pays a toll. Now let's talk about what this means for you. Because this isn't abstract, this isn't theoretical, this is your money, your account, your financial life. You've been told that saving is smart, that keeping money in the bank is responsible. And it is, Sort of. But let's look at the math. The average savings account in America pays about 0.4% interest. Inflation in 2023 was around 4%, which means your money is losing 3.6% of its value every year just by sitting there. You're paying the bank to hold your money, not in fees, in opportunity cost, in purchasing power that evaporates while they lend your deposits at 5% and pocket the difference. And you can't opt out. Not really. You need a bank account to get paid, to pay rent, to function in modern society. The system is designed to funnel your money through institutions that profit from every transaction. You're not the customer, you're the product. Your deposits are the raw material. Your debt is the revenue stream. Your financial behavior is the data they analyze and monetize. The entire relationship is built on an imbalance of information and power. And the wildest part? Most people never question it. We accept this as normal, as inevitable, as the way things have to be. But it doesn't have to be this way. Here's the uncomfortable truth. Banks make profit because we've built a system where money itself is a product, where liquidity is a service, where access to your own wealth comes with terms and conditions. They don't make cars, they don't grow food, they don't build houses. They move numbers on a screen, and those numbers represent your labor, your time, your life. Every dollar you deposit is a loan to the bank. They don't call it that, but that's what it is. You lend them your money at 0.4%, they lend it back to the economy at 4%, or 14%, or 25%, and they keep the difference. It's not illegal. It's not even unethical by the standards of the system. It's just the way banking works, the way it's always worked. But every system has cracks. Every system has alternatives. And more people are starting to ask the question that banks don't want you to ask. What if you didn't need them? What if you could save without losing 3% to inflation? What if you could borrow without paying 15% interest? What if you could move money without fees, without middlemen, without institutions that profit from every breath you take financially? Some people are exploring cryptocurrency. Some are using peer-to-peer lending. Some are going back to cash. Some are building cooperative banks owned by members instead of shareholders. None of these are perfect. All of them have risks, but they exist because people looked at the traditional system and realized something simple. The bank needs your money more than you need the bank. They're not doing you a favor by holding your deposits. You're doing them a favor by providing the capital they use to generate billions in profit. And the moment enough people understand that, the moment enough people start asking what they're actually getting in return, that's when things get interesting. So here's the question I'll leave you with, the one that matters, the one no one likes to answer. If banks make billions of dollars in profit without selling anything, if they multiply your deposits into loans without your permission, if they charge you fees to access your own money, if they pay you almost nothing while lending at massive markups, what are you actually paying for? And is it worth it? Think about that next time you check your balance. Think about where your money really is and who's profiting while it's there, because they're counting on you not to ask.